Welcome back to the Hard Truths Podcast. I am your host, Denver Biddle III. Joining me is my co-host, Steve Traub. How you doing?
I'm doing good, man. How are you doing?
That's good. I'm good. I'm a little tired, but we're powering through. It's Tuesday.
Tuesday's the best day.
The best day, especially when it's a little sunny outside.
For sure.
And today, it's episode 33, but this is our third episode in our, still haven't really given it a real title, but like just our 101 kind of series where we're breaking down, from a fix and flipper perspective, the entire process of finding a property, acquiring a property, financing, like the whole thing from start to finish, acquiring your first property and doing your first fix and flip. And again, we are assuming that you know absolutely nothing other than the term fix and flip, right? So breaking everything down to a very granular level so that you can listen to this from the first episode to the last of this series, and you can go out and execute your first fix and flip, right?
That'd be great.
Perfect. So today we are going to be focusing on the topic of choosing and evaluating your first property and your first project. We're really going to be honing in on the valuation side of things, right? How to find out how much something is worth and if you have a deal or not, quite frankly, because that's the most important part. I feel like I hear, at least from, people on the lending side, like some of the processors, some of the originators, there'll be these applications that come in on these properties and, we run the numbers we kind of just sometimes even look at it from a glance, like based on the, because we've done this so much, looking at different neighborhoods, and we'll hear like a zip code and a dollar amount and go, yeah, no, that's not I don't even have to run this through the team. Like this isn't a deal.
For sure.
Like knowing your numbers, I've heard it from so many people, is so pivotal, is so important. In business and especially here in this process. And we're going to dive a little bit more into how to go about how to know your numbers. Like, what does it mean? Because people say it all the time, but like, here's how to actually know your numbers.
Yeah.
So with that being said, the first section or subtopic that we're going to get into is choosing the right location, right? Like I said, certain zip codes, certain areas, certain neighborhoods, we've all done it. We've driven through different parts of town. We've seen different looks, different physical traits, right? Different levels of beauty, for lack of a better term, right? Yep. So again, from a beginner's fix and flippers perspective, where should I start when it comes to choosing the location for my investment property?
Yeah, that's super loaded, but a very important question.
Yeah.
So there's a lot of different things that you want to look into, but I heard it 1,000 times, but people are always saying location, location, location. Couldn't be more true, especially in real estate, because most houses you can't just pick up and move. So they are where they are.
Right.
So I hope you love the area. That being said, though, different neighborhoods are going to yield different profits for investors. There's different things that people look for within those neighborhoods to decide, hey, is this a neighborhood that is up and coming? Is it already fully established? What's the story with the specific location? And then really, like, what am I looking for to make that determination as far as, hey, I could buy a property on, the west side of Milwaukee or the east side of Milwaukee or the south side of Milwaukee, the north side, what does that look like in different places? Of course, every city is a little bit different. So
right.
Here's the old shameless plug, but certainly, talk to an industry professional if you don't know an area, and, they can certainly help kind of point you in the right direction. So something to keep in mind is houses appreciate. So every single year, with the exception of 1 year in the last 55 years, homes across the United States have appreciated. So one time they have gone down. We can all guess when that was, during the last housing crisis, 15 to 20 years ago, but it was for one calendar year. So keeping that in mind, a normal appreciation rate on a property is somewhere between 3 and 3.5% growth. Across the US, that's a pretty standard number. What you're looking for, though, is the neighborhood that, hey, I'm going to put this amount into this neighborhood. It's up and coming. Maybe that appreciation factor is closer to 7 or 10%. understanding that, somebody's going to see that as a better investment than the property that I'm selling that has 3% appreciation. So
with that, sorry to cut you off.
No, please.
You're probably getting to it, but what kind of things attribute to that accelerated appreciation rate?
Sure. Up and coming areas in general are going to be considered, usually higher appreciation areas. So some of the things that, they may be doing to an area. So for example, say there's a new, restaurant being put into place, or a new mall, or a new, community center within a specific neighborhood. Like that neighborhood right now may not be as desirable as it will be once that community center is in. So, you're trying to kind of, use the knowledge that you can find regarding these neighborhoods. So a couple of things like neighborhood growth. Are there new businesses going in? What does the crime rate look like? Is there any sort of public infrastructure in place for them to, again, adding, more jobs to the area, maybe adding a new neighborhood, maybe adding, some better streets and some easier traffic flow. We're here in Milwaukee. So one of the things to consider is when people are like living in Milwaukee, you and I commute downtown every day.
Yeah.
It's like me commuting from, where Brett and those guys are is a hell of a lot longer than where you and I commute from. So
especially me, I'm across the street.
Yeah. You're walking here,
Yeah.
but, no, it's one of those things to keep in mind, is that neighborhood accessible? And then who is ultimately going to want that house? So a few other things, just to keep in mind too is, school districts are important. You and I have talked a little bit. I'm in Wauwatosa. Wauwatosa right now is school choice. Starting next year, it's not. So if you don't have kids if you're not living in the area, you no longer have the choice to be able to send your kids to a specific school district if you want to, just as an example. So something to keep in mind, knowing again, that houses there are probably going to appreciate a little bit higher. If people ultimately want to get in the school district, what do they have to do?
They got to move.
So, that's important as well. And then accessibility, we talked a little bit, but like major highways, public transport, different amenities, whether that's parks, for a family to take their kids to, different shopping areas. Again, maybe they, like a good nightlife. They want to be closer to a downtown area. Everything's going to be a little bit different for people, but it is something, important to consider is all of these factors that go into a property, that all goes into the neighborhood. That is all stuff that you should be considering when you're evaluating a particular area, to buy your next fix and flip.
Yeah, it's a lot to think about.
It's a ton. It's a ton, right? And it's like, do you think about these things, when you're driving through a neighborhood, like yes or no? If the answer is no, hopefully it turns into yes here pretty quick.
Right.
So, and there's a couple of kind of questions that you could ask, a local professional, like a real estate agent, somebody that's been in the area a long time, maybe another flipper, and really like, what are those kind of important questions that you should be asking? What neighborhoods are seeing the most growth and the most revitalization of their city?
Write these down, guys.
Please. Or reach out to us either way.
Yeah.
Are there any areas that buyers are flocking towards? We just talked about school choice no longer being a thing for some areas. Like, is that going to force somebody to move? Likely, yes, if they want to stay in the same school district.
Yeah.
And then are there any new developments? We've been looking at, my wife and I have been looking at houses here, kind of more in, pedestrian friendly neighborhoods, that sort of thing,
Okay.
and some of the things that they've been trying to kind of sell us on are, hey, we do have more parks, we have more green space, we have more areas for you and your family to be able to walk and enjoy some of the local stuff. So just, you want to, again, dive into what developments are being done, what's already been done, and then who are you trying to appeal to and what do you feel like is going to be important for them? Those should all factor in here for you helping to kind of choose the right location.
Yeah. What neighborhoods have been touting that they're pedestrian friendly, by the way? Cedarburg and Grafton, yeah. Which it's like you still have to walk 14 miles to get to the grocery store, but right.
The point is there are sidewalks, Denver.
Yes.
And that's one of the good things. But no, in all seriousness.
Coveted sidewalks.
Yeah, right. Parks within the neighborhood. No. Right. So there's a lot of different things that, people will feel like are important to them. And it's just, again, when you're buying the property, who are you trying to sell it to at the end of the day? And what do you feel like is going to be important for those people?
Yeah, makes sense, right?
Yeah.
Obviously you're going to, at the end of the day, you're going to try to sell this house. So you want to have multiple selling points, and having a location with all these things, at least if you're ranking them 1 through 10, right? Having high rankings in all these categories makes it, probably a more desirable house in addition to, whatever it is you're doing inside, right?
Absolutely.
Yeah, that makes sense.
Absolutely.
Cool. So let's just say we've ran the numbers on all of this, done all the analysis, and we found a location that's the best of most of these worlds, right?
Sure.
So a lot of times in neighborhoods, you'll see a kind of a mix of different kinds of properties. You'll have like single families, you'll have like duplexes, maybe like some quadplexes in there. How do you go about evaluating what kind of property you want to invest in?
Yeah. Again, I think, we had talked in the initial episode about figuring out, what your long-term goal is too. Of course, a lot of people are going to fix and flip these properties. That's why we're here. If you do decide to fix, and hold and refi, that's a different conversation, but just something to consider, that is what are you going to do with that property kind of long-term. But when you are looking at, single families versus multifamilies, commercial space, which we had talked about, 4 units, 5 units, 6 units, something like that. You're going to have to decide really how much work do you have, to complete, what's your timeline, and then how comfortable are you with it?
Right.
I'll say this, 70% of the flips that are done by beginners in 2023 were done on single family homes. Single family homes have a little bit slighter or less risk, I should say, but the potential for more profits more than likely outside of the unicorn situation, which you got like the sweetheart deal of the year. Yeah. Those multifamilies are going to help you kind of recognize some more profits. Again, they're likely more expensive, higher rehab. Likely you should have a little bit more experience if, unless you're really comfortable to dive into those, but that's something to consider, kind of what are the differences, and then when you decide, hey, I want to do a single family or a duplex, what are the things that you want to look for in a property? Like what makes a property a good fix and flip candidate? That's something to really consider. And is there anything that jumps out at you, Denver, that you would say, hey, when I'm driving past this house, or I have an idea of the house I may be interested in, like, what are you looking for in that house prior to you purchasing it?
That's a great question. And I should be equipped to answer it because I just put together a webinar with Scott, our boss, and we talked about this, how to find, is something a good deal or not?
Yeah.
And of course, to have a good deal, you need to have a subject property. And from what I remember, there needs to be some form of distress, right? Yep. The more distress, the more motivated the seller is going to be, whether it's physical distress with the home or there's some financial distress going on. They need to sell, they're underwater. So a distressed property, if we're talking physical distress, and we're talking, to beginner fix and flippers, something that doesn't need a massive overhaul. From my understanding, I'm no expert in this myself, but some of the more expensive repairs, so foundational repairs and just things that are structural issues or fire damage and, things like that, where a lot of structural things need to get repaired and fixed. Am I along a good line?
In my opinion, for sure. Okay. And Scott is the guru, don't get me wrong.
Right, yeah.
Which is
why get him on one of these episodes.
For real. But no, you're right on. Distressed properties, right? Properties that need repairs that either maybe the current seller or owner, I should say, isn't doing for whatever reason. Maybe it's a rental property. They just don't really care. Their tenants never complain. Maybe they moved out of state and they, had an issue selling their property for whatever reason. Sometimes people will take them over, an inheritance, someone passes away. Hey, I'm leaving you a property in Alabama you know nothing about, trying to, kind of find those properties that are distressed, because a lot of times with some fix and flip upgrades, you're going to be able to recognize some pretty significant profits, versus going and trying to do a fix and flip on a house that is already 95% of the way there and updated. It's what are you really updating and changing, right? Yeah. How are you going to make your money at the end of the day? Exactly. So looking for the distressed properties, looking for aging homes. So again, I always use kind of the person that, maybe moving into assisted living or, just can't take care of the house anymore for whatever reason. Those houses, you walk into them, we bought one, it had crazy green carpet, Like, dude, paint from the 50s.
Beautiful.
It was, I mean, it is,
Yeah.
I like it, but that's one of us. But
Right.
no, anyways, it's the aging properties because they offer a really significant, value in what can I flip, what can I change, and how can I update it to kind of say like people's modern tastes. That's an ideal candidate for a flip. So, and then one other thing, to kind of just keep in mind when you are, evaluating these property types and that sort of thing is houses will sit on the market for different amounts of time, right? Maybe not everybody's looking for a duplex. So duplexes, let's just say, sit on the market for 60 to 75 days before they close. Let's say a single family sits on the market for 30 to 45 days. When you're taking out a hard money loan, a lot of times, again, it's a shorter term loan. Take the property that is likely going to sell within 30 to 45 days, unless you have an extended time period for whatever reason.
Yeah.
Right? It's like you want to know how long is it going to be on the market for, hopefully, and then how quickly can I get rid of it?
That's when you make your money.
Absolutely. And again, these are all things that go back to asking a market or an industry professional, right? Realtor, appraiser, other property investor, whatever it might be. So, what types of properties are selling in the area quickest? Are there any specific property features like open floor, modern kitchen? Again, this isn't always about me, but selfishly, it's going to be right now. We're looking at opening up our kitchen, right? It's like, I've got a kitchen from 1952 that's 10 by 10. It's like I take a wall out, it doubles in size, everybody's happy, So beautiful. Some of the things that you're looking at, when you are going to go in and kind of evaluate those properties. All right. What's next for us?
What is next? So we've chosen our location.
Yep.
We've identified what kind of property that we're going to be looking for and hopefully acquiring. Probably going the single family route. Mm-hmm. So now we're talking about analyzing this, just talking about the property's potential, right? Talking about evaluation metrics, ARV, what will this thing be worth once we actually do the work?
Sure. And let's just, again, I like examples because I think that it's easier, hopefully, to follow along, understand what we're trying to do.
Make it tangible.
Exactly. So you can almost see the house and hold it in your hand, Yeah. So let's just talk about this example, for the sake of our conversation here.
Let's do it.
Purchase, you're buying a property for $120K, right? $30,000 in repairs. We think that property's worth $200K when everything's all said and done. So let's just use, again, buying it for $120, $30,000 in repairs, ARV is $200K. So as a beginning investor, let's assume that you're doing 20% down plus closing cost fees. Just to give you a really loose ballpark, let's call it $35K out of pocket, right? So you got $35K out of pocket. The lender is going to lend you basically 80% of 120 grand. I don't expect anybody to do the math because it's 96K. I see Denver calculating in his brain. 126 grand.
12 times 8.
Carry the 2. Wait. No, it's so 96 plus the 30 in repairs. So we're going to lend you 126 grand as a lender. So again, $24,000 down, closing costs, loan fees, insurance, 35K out of pocket. Property turns around, you're going to sell it for 200 grand, right? Everything's all done, buttoned up, you're at the closing table. So you got 200 grand minus what you owe the lender. So you have $74,000 left, right? You're going to pay a realtor. Maybe you guys took our advice. You got your real estate license. Maybe you don't have to pay a real estate agent, but let's just assume you do.
Yeah.
You got title charges, whatever it might be. Let's call those fees 8%. What does that leave you at the end of the day? It leaves you $58,000 coming back to you at closing. So your initial investment is 35 grand. You got an extra 23K coming your way for 4 to 6 months in effort. So again, if you're a real estate agent, you want to save yourself 3%, 4%, 5%, whatever it is. I mean, you just keep adding to it. So your ROI there is almost 100% on that money that you're investing. Kind of a cool situation. So, again, when you're coming up with that $30,000 repair budget, what does that all entail? Go find a professional. Hey, Mr. Contractor, I'd love to use you for my next project. Would you mind walking through 123 Main Street with me to make sure that you feel like my budget of $30,000 is realistic for this project? And then you had mentioned, you and Scott, evaluating a basement, right? You're doing foundational repairs. How much are those foundational repairs? Is that something you want to deal with? Is that something the contractor is comfortable with? Foundations can be scary and can be quite expensive. So, again, just trying to kind of figure out what updates you're going to do and making sure that that budget is realistic for you. If it is, you got 58K coming back to you at closing.
So good deal to me.
I mean, yeah, you do 2 of those a year, man. It's
balling.
nuts. Yeah. Might as well quit your job. Except for us.
You didn't hear it from us.
Yeah. All right.
So I did have a question as we were going along.
Yeah, man, fire away.
Yeah. So when doing, obviously the more margin, right?
Yeah.
The bigger the spread between the ARV, what you think the property is going to be worth, and what you're buying it for, the more profit that you're going to make. Is there a range, like a percentage that we should try to stick around as it relates to the purchase price and what you think it's worth? Because I feel like at some point, whatever percentage that is, there's going to be a point where it might not be worth all the trouble, all the hassle of repairing and doing all that if you're only making, X amount of dollars.
Yeah. I'll tell you, it's not 1%. So
yeah,
that's one to know for sure. But I mean, I think a good kind of gauge for it is 15 to 20% profit at the end of the day, or profit margin, I should say. It's up to you really, like what's your time worth? But the last thing you want to do is put yourself in a bad situation where you think something is worth X and it's worth Y, and then you're making 2%. Leave yourself flexibility. The more flexibility you have, the easier these projects are for you, the more you can do, the more confidence you have. And just, you're trying to grow. It's like anything, you got to crawl before you walk in a certain situation. So set yourself up for success. Don't choose the property that has a 5% profit margin. There just isn't enough room for you there. Please don't make that mistake. And again, seek out a professional, get somebody's opinion on it. If you trust them, they seem like they have an idea of what they're talking about. Chances are you should value that opinion and really use them as a resource.
Yeah, because tight margins. That 5 can turn into a -5 really quick.
Very quickly. And, I have a friend that lives in Arizona, and he's told me some of the margins that those people work with down in kind of the Phoenix area. And it is scary, man. Like
just crazy tight.
8%. It's like 1 or 2 quick, kind of
what are we doing?
Moves in the wrong direction. It's like that can carry on and cause some serious pain long term. So set yourself up for success. Ask an industry professional, please.
Yeah, because 8%. I mean, might as well just put it in the stock market at that point. Put it in Bitcoin. See where Bitcoin's at?
I wish I had more invested.
I know, man. You and me both.
All right, that's a separate podcast, though. I'm sure there's an episode about it.
Cool. So we've got some tangible numbers, a tangible example. We're feeling ready to do this just about. So moving on to, I guess, like estimating some of those repair costs, like getting even more granular.
Yeah.
What are, I guess, because even from what I've heard the last maybe like 4 or 5 years, repair costs have just gone up and are continuing to go up. Talking to contractors about the cost of materials, and I mean, you see it reflected in the home prices, right?
For sure.
So I guess, how do you even today, right? If I was to try to estimate renovation cost and whatnot, what is the best way to go about doing that?
Well, I think, kind of deciding where you think you're going to get the most bang for your buck as well is important. So just as an example, like kitchens and bathrooms, a lot of times, those are the renovations that are going to pay dividends at the end of the day. Right. You spend a lot of time in the kitchen. We don't need to talk about how much time people spend in the bathrooms, but it's considerable. But no, great question, man. I think kitchen renovations in general are usually the most expensive, right? Maybe outside of foundation, it's typically one of the most expensive ones. So say maybe, 15 to 25 grand for a kitchen remodel. Sometimes you can squeeze it out a little bit less. I'm not a believer in using the cheapest materials. I think that when you walk into a property that someone has done some renovations to, you can kind of get an idea of, how good the quality of materials that they've used are. And I'll just tell you, when you're walking in as a home buyer, it's like the last thing I want to see is, 99 cent per square foot, LVP flooring. It's like, I'm going to replace this in 6 months. Can we just spend $2 on flooring. You know what I mean?
Yeah.
So something to keep in mind. But that kitchen, you're probably 15 to 25K. You know, a bathroom, depending on if it had, you know, is it a half bath? Is it a full? Does it have a shower? Is there a tub? Say 5 to 15. You know, and then of course, when you drive up to the property, your first opinion is, what does the outside look like? You know, it's like, that's the first thing you see is the outside of the house. It's like, so, you know, spend some money on landscaping. Let's say, you know, $3 to $8,000. Maybe you got to regrade the yard. Maybe you got to seed the yard. Maybe you have to, you know, pull the 10 years of weeds that the previous owner left there for you. Whatever the situation is, you know, you just want to make sure you have at least a good value range for those budgets. And I would say err on the side of caution. If you tell me my bathroom is 15 and it's 8, I'm not upset. But when you say your bathroom's 8 and it's 15, what if I didn't bank that 7 into my budget? I mean, now we're talking about
those profits.
Yeah. What profits? You know what I mean? Yeah. You just handed them to your contractor or yourself or whoever's doing the work. So again, you know, some of the highest kind of return on your investment is going to be kitchens, bathrooms, landscaping, aka curb appeal. And then really a lot of people like kind of an open layout of a property. So they like, you know, being able to like be in the kitchen, making dinner, watching the kids, you know, look at their phones, I guess, or whatever they're doing. But, you know, just something to, you know, kind of consider is those, and then maybe doing some energy efficient stuff. Maybe you've got energy efficient windows. So, you know, hey, Denver, I'm selling 101 Main Street. These windows are awesome. You know, they're top of the line as far as energy efficiency goes. Like your energy bill, instead of being $300 is $125 a month. Like that all goes into people's thoughts and consideration when they're buying a house as the end consumer is, you know, what do these bills look like for me at the end of the day? And, you know, also the last thing you want to do or not do, I should say, is you don't want to be the person that overdevelops a house for the neighborhood, right?
True.
Sure, I could put in gold fixtures, but like, does the market support solid gold fixtures? Probably not. Obviously not a great example, but the last thing, you know, you want to do is have the house that you spent $300K on. The highest comp in the neighborhood is $270. And it's like, what are we doing here? No chance you make that money back. So again, budget, make sure you're evaluating situations before you get into it. And again, I've said it 15 times. We're going to say it 30 before the end of the episode. Ask an industry professional. Ask somebody local that has an idea. Take their opinion. You don't have to listen to it, but you should at least hear it.
Yeah. Yeah. Especially if you're a beginner. Like you want to do as much research as due diligence as you possibly can. Because
absolutely,
it's really, well, I don't know, but I would, again, me having a little trepidation in being a beginner.
Yeah.
My biggest thing would be not being able to sell this thing or under budgeting. And like you kind of mentioned earlier, eating into those profits or what we were shooting for 15 to 20% becomes 5 to 10, becomes 0. And you kind of ruin that first deal experience. And then you never want to do it again.
For sure. But at that same time, I'm going to be the optimist. You could flip that to a rental, right?
Very true.
Houses appreciate at 3%. It's like, yeah, you overshot your budget by $100K. Your profits are 0.
Right.
Wait 5 years, have somebody else pay down part of your mortgage. You know, let's get rid of that house for you, you know, in 4 or 5 years when your profit margin is where it should have been in the first place. So something to consider is always just being flexible.
Yeah. Yeah. That risk tolerance phrase comes into play there.
Absolutely.
Cool. So, kind of shifting gears a little bit, we touched on earlier some of the things to look for that would make a property an ideal or optimal property for a fix and flip project, right?
Yeah.
So kind of the opposite of that, what are some things to look out for that you might want to stay away from, like some red flags in properties as a beginner?
I think there's a couple of important ones. You touched on a lot of them, and we'll just kind of recap on that. But foundation issues, you know, fire damage, like previous mold or current mold, you know, significant water issues, like whether that's a hole in the roof, it's been getting water damage for 5 years. You know, just you want to make sure that you're looking kind of at every corner of the property. I don't remember, we're not going to mention his name again, but we went to a property here, you and I, maybe 3-4 weeks ago. We walked into the basement and I just had pointed at one of the walls and said, hey, did you check this out? Right. And he was like, yeah, I had no idea. He looked, you know, there was a workbench there. He really couldn't have known, but he walked into some foundation things that he wasn't really expecting, and certainly something I think that would have deterred him from that property had he have seen it from the get-go, or he would have offered $5,000 to $10,000 less, knowing that, hey, I've got to do $5K in foundation repairs or whatever that situation is. So I'd say problems with the house, right? If it's got knob and tube wiring, like old school, doesn't get approved anymore, very prone to fires, it's probably going to be pretty significant for you to have to replace that. So I just want to make sure, again, you guys are thinking about things, even if it's in the wall and you can't see it, it's something to consider. And then somebody who can help you with that is going to be, an experienced inspector. When we had purchased our house, actually, we had an offer in on a fix and flip. The person that did the fix and flip did not pull any permits. It was so bad to the point that there's a water line on the fridge for an ice machine. They never even ran the water line for the fridge, so it wasn't plugged in. So the inspector, got me personally out of kind of a bad situation for a property my wife and I were considering, on things that I wouldn't have known had he have not pointed it out. Hey, this is going to be $25,000. I was like, I don't even see what you're talking about, but thank you for letting me know.
Yeah.
So you relying on somebody, again, who's a licensed inspector, they do good work. That's going to be important for property stuff. Now let's talk about the stuff that you maybe can't see, like crime rate, right? Crime rate's going to be important. Like when my kids are outside playing, as a parent, I want to make sure that they're in a safe neighborhood, and there aren't going to be issues with them, walking to the park that was important to us when we bought the house, the park that's 2 blocks away. I don't want to drive them to the park. I want them to be able to have the ability to walk, so right. Kind of area, not even call them issues, but you just want to know, if there's any significant red flags that a buyer would see, right? If the property is, right next to the highway and the only chance that you have to go to the park is to cross a road that's 55 miles an hour, that's going to be a problem for a lot of families, so just kind of stuff that doesn't go into the house, but is still important to think about. So again, do your research, ask a professional, and try to figure out, what may prevent you from making the profits that you think.
Yeah. The common theme here is that there's a lot to evaluate. Everything from, location to your actual, the deal numbers and deal metrics, staying clear of any of these red flags. Some of these things can be addressed the more experience you have, but some of these things are just, they're not, they can't change. Or they won't change immediately. Like you said, like some of the location things that are just the characteristics of the neighborhood. So you just want to make sure that you're aware of all of these things.
Absolutely.
And there's really no rush, right? Like once you've got your loan and everything, then it's, game on. But before that, making sure you take the time to, again, do all your due diligence to mitigate any, additional risks to what risk is is just inherently in the act of investing in the first place.
Of course.
So,
yeah. And I think even some, things to consider that we hadn't mentioned before, but, I could mention a hole in the roof, but how old is the roof? Is that something that is going to need to be replaced by the buyer when they purchase that property? How old is the furnace, water heater, AC unit, siding on the house? What does that look like? And again, I know there's a lot of information for us to unpack here, but this is what it takes to be able to make $30,000 in 6 months is some research, right? Or everybody would do it. And how else can you get confidence in what you're doing but by practicing? I know AI didn't believe in going to practice, but it's like, we still know he practiced. You know what I mean? He wasn't just out there, dribbling his first time ever, crossing up Mike, but we won't get into that either.
He had to get to a point where he could skip practice.
Exactly. Yeah. And he earned that. So I like to think some of our seasoned investors are still going to practice. They're still doing this research, but again, you as a beginner, take your time. Nobody's rushing you to make you do this tomorrow. Do your research. Yes, the housing market is competitive. Yes, you need to write a competitive offer. Yes, you may miss out on a property that you would have possibly been interested in. but it's better than the alternative of you just jumping at something with no idea what you're doing, overshooting what you think a value may be, undershooting what you think repairs may be. And you just weren't prepared to write an offer. So, do your homework, do your research. And then I think, again, we've talked about 900 times, but seek out a professional. And I'm going to transition us, Denver.
I was going to say, man, perfect segue into what I wanted to talk about.
Please. And I'm going to let you run with this one a little bit, right? But it's like, okay, so based on our conversations that we've had so far, it feels like you need to build a team, right? It's not just
100%.
It's not just the Denver Biddle the Third show. It is, hey, I've got these industry professionals that are able to help me. Mind just recapping for me, what your ideal team would look like? Who are your teammates? And then really, like, what do they help you do?
Yeah, the first step would be, when you're looking for a property, I would imagine it would be somewhat helpful to have some kind of real estate professional, such as an agent that knows the neighborhood or neighborhoods that you're looking into. They can give you some neighborhood data, some statistics and whatnot to evaluate some of those things like crime rate. Is it up and coming? What kind of developments are being added, have been added? Things of that nature. You find a property. And then you would need to make sure that you have some kind of team in place for the repairs, the rehab, right? Yep. So linking with some kind of general contractor, or if you have, multiple guys that, that specialize in their different areas of, rehab and repair, whether it's the GC's team or your team, having a team of people that can get the work done. And then once you have all of that in place, trying to think what other aspects. Well, if you're going the hard money route, you would need a hard money lender, that's where the hard money code comes in. But yeah, those are the three, I guess, categories of team members that I can think of. Am I missing anything?
I would say the only one that I would add to that, if possible, is to get an inspector in there.
Oh yeah.
A lot of times though, I know where you're going to go with that too, but a lot of times that general contractor may be an inspector. It's like, how else do they know, hey, this wall is bowing. Hey, I was a foundation guy for 12 years or whatever their background is. So sometimes those are one and the same. If they are not, how much is an inspection? $500, $600, something like that, I think.
Sounds right.
And one of our coworkers here just had, he's actually a property valuation guy. He does this every day, but he just had an accepted offer on a property in a local town that's close to us. And he had an inspection and he had offered the seller, a certain amount for the property. The inspection came back. There was some significant problems. Seller didn't want to hear it. He ended up not going through with the property. It's, hey, that property could have been a great deal for him. But knowing, hey, now needs $50,000 in renovate or in foundation issues and sewer and whatever else it is, that's into his budget. So, hey, I was offering you $200. It's now $150 because your house needs $80,000 in upkeep that you didn't know about.
Right.
So, but no, I think that'll definitely cover that. Covering building your team and giving you a great opportunity to be successful. Frankly. Beautiful. Yes, and then there are just one other, thing I wanted to cover with you. Yeah. And just kind of going back to doing some like market research and looking into properties that make sense. We've talked a little bit. We've got a gal that's buying a house that's been vacant for 15 years. It's a 2-family house in Chicago. Initially, she's doing $220,000 in renovations that after repaired value, let's call it $350,000. I don't remember the exact number, but let's call it $350,000. Yeah. She's like, hey, I actually think that this after repaired value is going to be higher. I'm like, why do you think that? She said, well, if you look online, there's an article posted by Chicago Business Times or whatever it was saying, hey, this development is going into this particular neighborhood. It'll be finished by the end of 2025, which is driving, I think it was something like 120 jobs, local to the market, allowed a bus line to kind of go back into a neighborhood that it wasn't in previously. They want to make it, more commuter friendly. That's an area that I would consider an up and coming neighborhood. So she said, hey, yes, it's worth $350,000 right now, but I think this number is actually closer to $395,000 when I'm done with this project in 9 to 12 months. Like, again, why do you think that? Because I did my research. That just shows you, like, do your do your damn research. I'm just going to say, do your damn research.
Yeah, man.
Figure it out. Ask questions. Look on Google. Google can be your friend. But at the end of the day, you need to know that this property is going to be worth this amount moving forward, or it is not a good deal for you. So we actually went back, adjusted her after repaired value based on this information that we had gotten. Now the project went from not making sense for her, in our opinion, to making sense for her, in our opinion. So it's one of those things that, again, her research allowed her to do a project that other people would have just maybe passed up on. So she's gonna make another $50,000 she wasn't planning on it. It's awesome. And great to see.
Just goes to show you, man, like we've said it quite a few times already in these past 3 episodes, but know your numbers. And if you don't take away anything else from this episode, it's what now? Do your damn research.
Please.
It'll save you. It'll keep your profit margins high and your risk low.
It'll make you successful at the end of the day. Maybe you can be successful without it 1 or 2 times. You know, maybe you hit a 3-pointer without ever practicing one, but like certainly it's not going to go very well for you long term. So as Denver said, do your damn research, get it together, and find some professionals that can help you if you don't feel comfortable making your own decisions on certain areas.
Boom. And if you have any questions, please feel free to reach out to us via social media. Again, at The Hard Money Co. The Hard Money and then CO on our website, thehardmoneyco.com. Give us a call, fill out an application, just get in our system, reach out to us in some way, shape, or form, because that's the one thing that separates us from everybody else. We know what we're doing. We have people here that are doing what you do, have done what you've tried to do or what you're trying to do. So we know a thing or two about what we're lending on, and we can give you, we can help you along. It's not just the podcast or the webinars that we have on our YouTube channel. We can actually speak to you about these things as well. So
yeah, I'd say one thing that we all share in common is we all just value, education and like being able to provide consistent value for people that maybe don't know where to look. This is what we do every day. I know Denver does, a lot of other stuff too, right? But we're diving into this every day. We see 20 to 30 applications a week at the absolute bare minimum.
Yeah.
I can promise you, if you have a situation, turn it in, do a damn application, let us look at it, let us help you, let us answer your questions, frankly, and let us help you take the next step to actually being an investor, quitting your job, getting some freedom, and living a happier, healthier life, frankly.
And our boss's motto, and it has trickled down, and really we all kind of embody this at this point, is we close deals.
What does the Hard Money Co. do?
Close deals.
Yeah, there you go.
You know what I mean? Like we filmed some pre-roll ads before this, and I think the stat you gave out was like 40% ish of the business that we get are takeover loans. So like loans that some other Joe Schmo couldn't close.
Yeah.
The borrower came to us. We figured it out and we got it done.
Yeah. We closed it in 4 days. Like if we're talking about the same guy.
Yeah.
And it's like, that's not uncommon for us. And just because one lender says no, doesn't mean another lender will say no. We're gonna go back to the Chicago thing. I know we're wrapping up this episode, but the other lender that she had worked with ordered 2 appraisals. They're like, I just don't see where the value is in this property. And the appraiser doesn't have any conversation with the client. Our appraisal's done here in-house. I was like, hey, here's what's going on with this neighborhood. Here's why it's worth it. Here's why I believe in our client. I won't name her. She's fantastic though, if you're listening. But it's like, we have an opportunity to help her out where somebody else dropped the ball. Like we want to pick up the pieces. We want to get deals closed. And like at the end of the day, the Hard Money Co. closes deals, period.
We close deals. And we want to we make money, blah, 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 whatever. But we truly care about our borrowers, and we want people to ultimately just succeed in real estate, succeed in their dreams, their interests, and just continue to succeed in real estate, because that's what we're doing. If we didn't care, we wouldn't be doing podcasts, like
free
this
podcast.
Yeah. This pays nothing.
Yeah.
At some point, maybe, hopefully,
we'll get a sponsor.
We get some people to subscribe.
Yeah.
And sure, we'll unlock monetization and all those things. But this is all this is all free. Like I'm not getting paid for this.
Yeah.
So
not officially.
Yeah. Not yet.
Yeah.
Not yet.
We're working towards it. But
exactly.
Well, thanks again, man, for having me.
Thanks for being here.
Yeah.
So that's, wrapping up this episode. And in the next episode, we're probably going to dive a little bit more into running the numbers. I know we kind of said I was going to talk about some of the numbers, and we did talk about, some of the numbers, but we'll probably dive a little bit more into ARV and like how to really, I guess, like set you up for success in terms of like profit margins and things like that.
Yep.
So that for sure it is a great deal. And then you can, again, go on and take it from that step.
That sounds awesome. I'm looking forward to co-hosting it, I should say. And we appreciate everyone tuning in.
Perfect. Thank you guys for listening. See you next time.
Thank you.
Peace.